You paid the card on time. You paid it in full. You did exactly what every financial expert told you to do, and your credit score still went down. That feels broken, but it usually is not a punishment, and it does not mean you did something financially wrong. It means your credit score is measuring something different from what most people think it measures. Over the next 10 minutes, we are going to turn that mysterious 3-digit number into 5 simple levers. And I will show you the date on your credit card statement that can matter to your score even more than the payment due date. No hacks, no carrying interest, just how the system actually works. This is plainly money. First, a credit score is not a grade for how responsible you are. It is closer to a weather forecast. A scoring model looks at the information in your credit reports and estimates how likely you are to repay borrowed money as agreed. Most common consumer scores run from 300 to 850, but you do not have one universal score. You can have different numbers depending on the credit bureau, the scoring model, the version of that model, the lender, and even the day the score is calculated. That is why the score in your banking app may not exactly match the score a mortgage lender sees. Income is not directly part of a FICO score. Neither is the amount in your checking account. The score mainly sees your history with borrowed money. Think of it as a photograph made from your credit report, not a live video of your entire financial life. For a typical FICO score, the information is grouped into 5 broad categories. Payment history is about 35%. Did you pay accounts as agreed? Were any payments late, and if so, how recent and how serious were they? Amounts owed is about 30%. This includes how much of your available revolving credit you are using. Length of credit history is about 15%. Older, well-managed accounts give the model more evidence. New credit is about 10%. Several new accounts and hard inquiries in a short period can make you look riskier, and credit mix is about 10%. The model can consider your experience with revolving accounts like credit cards and installment accounts like auto or student loans. Those percentages are guides for the general population, not a points calculator. There is no honest formula that says, do this and gain exactly 27 points. The same action can affect 2 people differently because their reports are different. But the first 2 categories explain most of the confusion: paying on time and how much credit appears to be in use. Suppose you have a credit card with a $5,000 limit. During the month, you put $3,000 of normal expenses on it. Groceries, insurance, a flight, nothing reckless. Your billing cycle closes while that $3,000 balance is on the card. The card issuer commonly reports a balance around the end of the billing cycle. Your credit report may now show that you are using $3,000 out of $5,000. That is 60% utilization. Then your payment due date arrives a few weeks later. You pay the entire $3,000 statement balance. You owe no purchase interest and your payment is perfectly on time. But if you check your credit before the issuer sends the next update, the report may still show the earlier $3,000 balance. The bank knows you paid. The credit report is simply displaying the last photograph it received. This is the distinction. The due date determines whether your payment is on time. The reporting date, often around the statement closing date, determines which balance may appear in the photograph. Paying the statement balance in full by the due date is the habit that protects you from interest on purchases when your card has a grace period. Paying part of the balance before the statement closes can also lower the balance that may be reported. That can be useful if you are about to apply for a mortgage, car loan, or apartment and want your reported utilization to reflect a lower number. You do not need to micromanage this every month, but you should understand why the number moves. Utilization is the percentage of your revolving credit limits that appears to be in use. If your reported card balances total $1,000 and your total limits are $10,000, your overall utilization is 10%. Scoring models may look at both overall utilization and the utilization on individual cards. One nearly maxed out card can matter even if your total across every card looks reasonable. You have probably heard that you must stay below 30%. Treat 30% as a warning line, not a magical cliff. Lower is generally better, and people with the highest scores often report very low utilization. But the exact effect depends on the scoring model and the rest of the credit file. Most important, you do not need to carry a balance from month to month. Carrying a balance can cost you interest. It does not prove that you are a better borrower. You can use the card, allow activity to report, and still pay the statement balance in full by the due date. The goal is not to pay interest for a score. The goal is to show controlled use of credit while paying as agreed. Now we can answer the bigger paradox. Why can a score fall after you pay off debt? Paying down a credit card balance will generally help or be neutral because it reduces utilization. But people often do a second thing at the same time. They close the card. Closing a card removes that card's credit limit from your available revolving credit. Imagine you have two cards with $5,000 limits and a total balance of $2,000. That is 20% utilization across $10,000 of available credit. Close one of those cards, and you may now have the same $2,000 balance against only $5,000 of available credit. Your utilization just jumped to 40% without $1 of new spending. Paying off an installment loan can also change the active mix of accounts on your report. A temporary dip can happen even though eliminating the debt improved your actual financial life. That last sentence matters. Do not keep an expensive loan open just to protect a few credit score points. A score is a tool. Becoming debt-free can be the better decision even if the tool briefly dislikes the change. Here is the simple system. Step 1. Automate at least the minimum payment. One missed payment can do more damage than almost any optimization can repair quickly. Set auto-pay as a safety net, then pay the full statement balance whenever you can. Step 2. Know your statement closing dates. If your utilization is high or you are preparing for an important credit application, make an extra payment before the statement closes. You are changing the balance in the photograph, not gaming the system. Step 3. Keep older no-fee cards open when practical. An old card can preserve available credit and contribute to a long history. Put one small recurring charge on it, automate the payment, and check it for fraud. If the card has a fee, encourages overspending, or creates a security problem, closing it may still be the right choice. Step 4. Apply with intention. A hard inquiry is not a financial emergency, but opening several accounts in a short period can affect new credit and average account age. Do not collect cards because someone promised a quick score hack. Step 5. Inspect the data, not just the score. Your score is calculated from information in your credit reports. If the report contains a wrong balance, an account that is not yours, or a late payment recorded in error, staring at the score will not fix it. Review the reports and dispute inaccurate information with the bureau and the company that supplied it. You can access free credit reports through annualcreditreport.com. Checking your own report does not create the kind of hard inquiry caused by applying for credit. 3 myths before we finish. Myth 1, I need to carry a balance. No, activity can report without you paying interest. Pay the statement balance in full by the due date when possible. Myth 2, 30% utilization is good. 30% is not a target. It is a commonly used ceiling. Lower reported utilization is generally better, but obsessing over tiny monthly score changes is not. Myth 3, closing every paid-off account proves responsibility. The score does not read your intention. Closing a card can reduce available credit and push utilization higher. Decide based on fees, spending behavior, fraud risk, and your overall finances, not pride. So why was paying on time not enough? Because on time answers only one question. Your credit score is also looking at the balance that was reported, how much available credit you have, the age and mix of your accounts, and how recently you applied for more. Pay on time. Keep reported balances controlled. Protect useful older accounts. Apply deliberately. Check the reports behind the number. Do those 5 things consistently, and the score usually becomes boring. And boring is exactly what you want from a credit score. If this made the system finally click, subscribe to Plainly Money. Next, we will explain why paying a credit card more often can change the number lenders see, even when your monthly spending never changes. No jargon, just money plainly.